Hi, I'm Paul Mitchell, Senior Fixed Income Specialist at HSBC Asset Management, and I'm joined today on Securitised Credit podcast by Andrew Jackson, who is the head of the HSBC Securitised Credit business. So look, investors are allocating to Securitised Credit across institutional, wholesale and retail for differing reasons, such as income generation and diversification due to the low correlations to traditional fixed income from this unique asset class. So we intend to discuss what's happening right now in the market, the spread widening across fixed income, and what to expect going forwards. So AJ, let's dive straight in. Given the recent trade restrictions leading to market volatility and spread widening across fixed income, how are you viewing the current market backdrop?
The current market backdrop is generating three things. The first really is inflation. It's likely to be inflationary, and that's going to lead to making it more difficult for central banks, particularly the Fed, to cut interest rates, which leads to a higher for longer sort of environment for us, which is good for this asset class. It's also going to lead to an economic shock to the system. That'll be a little bit more broad-based across the global economy. And therefore, spreads in our sector have also widened in sympathy with fixed income. So spreads are now wider than they were prior to this current event. However, this asset class also benefits from credit enhancement. So this is the ability to withstand a recession, ability to withstand an economic shock. So actually, the asset class is well placed to to manage through certainly a mild recession, and particularly for the senior and mezzanine tranches of a securitization. And what that leads to is the ability for us to add risk selectively and carefully in this environment, given the higher returns on offer. And the final piece really is that there's a lot of uncertainty in the market. So therefore, we always trade with care, but particularly at the moment, we're trading carefully and investing carefully on behalf of our end investors.
All good points. So what does an allocation to securitized credit actually, offer investors?
The asset class is largely floating rate. That means it's short duration, very short duration. And therefore, we pay effectively base rates plus our credit spreads. Base rates are higher for longer. So there's good income coming from this asset class. That also means that we are a good diversifier in a fixed income portfolio. Many of our investors come from a fixed income background, and many use this asset class as a diversifier within a fixed income allocation to say do 20 or 30% of their fixed income allocation into this asset class. Essentially, what it does is it provides higher returns with a lower volatility and adds a great deal to an existing fixed income portfolio. Because of the way a securitization is put together, we have the ability to choose the risk point that we want to invest in. And we similarly have a number of products that actually can be very defensive or even a little bit high yielding. And that's all wrapped up with the ability to benefit from that credit enhancement in the event that there is a shock to the economic system.
Okay, so why are investors looking at securitized credit versus traditional fixed income, as you mentioned?
Essentially, it's all down to the yield premium, the wider credit spreads. We've always been wider in terms of the credit spreads that we pay compared to our corporate cousins. That has been maintained at the moment, and that's due really to the complexity of the product or the credit risk embedded in it, and that's likely to continue. So essentially, we pay more. It is a credit product. The other part of that is liquidity, and this product is also somewhat less liquid than our corporate cousins. I would say that at the senior tranches, AAA, AA, single A, actually liquidity is pretty good, but we acknowledge that there is a premium being paid again on that. So essentially, investors look at this asset class because we pay more.
Okay, I mean, liquidity is key for clients. So do you have any concerns about the market liquidity?
Short answer is no. It's a very large market. It's about $4 trillion, the global market as a whole. Whilst we acknowledge it is a little bit less liquid, it is still quite liquid. And what we've seen in the current environment, post the immediate shock, actually liquidity returned quite well. And we've seen that feature again through previous crises, such as the COVID crisis, you know, the Russian-Ukraine situation. So, you know, actually the asset class recovers quite well. We're seeing reasonable secondary activity now, and even the primary market has recovered, you know, within a couple of weeks of initial announcement. So we manage it very carefully. It is something to be considered. We acknowledge the slightly less liquid nature, but within that, actually, no, we have no concerns.
Okay, good. So, but how do you and your team actually identify the opportunities themselves?
So we have to have two main processes. The key part of that is the bottom-up approach, and here the team is you know, both experienced, but we're set up to address the 2 points of value in the chain. First of all, our portfolio managers are specialists in their area. They're well known to the relevant dealers, and they're really there to unlock that liquidity risk, that liquidity premium. But the core of the team is based around credit risk analysis. You know, every transaction goes through a very thorough credit analysis, and we take the credit risk management, the complexity risk, if you like, very carefully. But we ally that bottom-up approach with a careful top-down approach. We have a formal meeting every month where we look at the risks and opportunities that are emerging in the market, never more so relevant than today. And so what we're doing is we move our portfolio to where those opportunities are best, and where the relative value is providing us with the greatest opportunity to provide that income that we like to do, and clearly avoiding the risks.
Yeah, all good points. So how strong is the actual investment case for securitized credit bonds right now?
I think it's strong. It's strong essentially because I do think there will be somewhat of an economic shock to the system. Now that shock actually is not looking like a sort of complete crisis, and so securitized credit looks very well, performs very well in that sort of mild recessionary environment. We may not even get to that environment. So we have that credit protection, which I think is absolutely key. We're also set for an environment where we will continue to generate quite strong current income, which is something that investors really quite like. Market liquidity is something that we do manage very carefully. We are very aware of the issues there. As I say, recently we performed sort of adequately through this sort of current situation. But essentially, all of those points, yeah, the careful management of liquidity, you know, the strong income, you know, the protection in the event of a recession, adds up to quite a powerful ability to resist, you know, a deteriorating situation. So actually, I think the credit case is strong.
Okay, all very good points. So many thanks for your time and responses, AJ, for sharing your views on the current market environment, which is key for investors, the diversification benefits, and why the case for securitized remains attractive this part of the cycle, but also the need for a considered management from an experienced team. So thank you very much for your time. And from me, please do contact your HSBC sales representative for further details on our HSBC securitized credit offering. Thank you.